Welcome to P2 Corporate Reporting. In this section, we are going to look at the convergence between national and international reporting standards. The convergence of US GAAP and the IFRS is an important topic, and it is very examinable. Convergence means the joining or merging of the two systems, bringing the two sets of standards in line with each other. You are well aware by now that if companies prepare their financial statements using different standards, this can make comparability difficult. So, in 2002, the Norwalk Agreement was signed and is the starting point for a project to converge the two reporting systems. The IASB and the FASB committed themselves to develop high-quality, compatible accounting standards that are suitable for both domestic and cross-border financial reporting. The Norwalk Agreement identified two key objectives. 1. To make existing accounting standards compatible. 2. To maintain compatibility once convergence had been achieved. A few years later, in 2006, a Memorandum of Understanding, MOU, was published. It was also called the Roadmap and identified short and long-term convergence projects. This was based on the following three principles. 1. Convergence of accounting standards can be best achieved through the development of high-quality, common standards over time. 2. Trying to eliminate differences between two standards that need significant improvement is not the best use of the FASB's and the IASB's resources. Instead, a new common standard should be developed that improves the financial information reported to investors. 3. Serving the needs of investors means that the boards should seek convergence by replacing standards in need of improvement with jointly developed new standards. Once the MOU, the Memorandum of Understanding, was agreed and the priorities and milestones were set, the short-term convergence topics that were identified either as high priority for convergence or where convergence could be easily achieved included the following. 1. IAS 23 permitted borrowing costs on the construction of an asset to be either capitalised or written off, but US GAAP required such costs to be capitalised. IAS 23 was amended in 2007 and is now in line with US GAAP. So now, from 1st of January 2009, borrowing costs are capitalised where specified criteria are met. IAS 14 segment reporting has been replaced by IFRS 8, which you learnt earlier in the course. IFRS 8 identifies reportable segments based on a managerial approach, which is consistent with the approach adopted under US GAAP, rather than the risk and returns approach that IAS 14 adopted. IAS 1 was also revised. The balance sheet renamed as the Statement of Financial Position. The income statement was renamed as the Statement of Comprehensive Income and now includes items of income and expense that are not recognised in profit or loss, but were directly recognised in equity, such as revaluation gains. IAS 27 and IFRS 3 were amended, and the new standards change the calculation of goodwill and the treatment of piecemeal acquisitions. Along with changes to US GAAP, these amendments bring the accounting treatment for goodwill into line. But some differences still exist, like the definition of control and fair value. Many recently issued reporting standards eliminate or narrow down the range of permitted accounting treatments. It is possible that, in future, the accounting policy choice for measurement and recognition of goodwill may be narrowed down by requiring entities to adopt a consistent accounting policy for all acquisitions where control is acquired, rather than goodwill accounting policy being decided on an acquisition by acquisition basis, or moving towards a single accounting policy of accounting for goodwill at fair value. In 2008, a second roadmap was agreed, and after it, some eligible companies began to prepare their accounts according to IFRS GAAP. There are still many differences between the two systems, and there are long-term projects in place to harmonise the following areas. 1. Fair value measurement. 2. Post-employment benefits. 3. Revenue recognition. 4. Leases. 5. Earnings per share. And 6. The conceptual framework. What about the national standard setters? Most have now a policy of either convergence or harmonisation with IFRS. If we look to the UK standard setters, the Accounting Standards Board, AASB, believes that the UK's principles and the international accounting standards should be harmonised. This means when new standards are being drafted, they consider any relevant international standards and will incorporate the principal requirements within the UK standard. Many other national accounting standard setters do the same, so the standards are harmonised. Another important point is that any listed company in the European Union must prepare their annual financial statements in accordance with IFRS. So it makes sense that local standards are harmonised with the IFRS. So, as you can see, convergence is a massive project, requiring a huge amount of time and investment. Why do it? The benefits of a harmonised global system are: investors can easily compare companies' accounts from different countries. It helps encourage cross-border investment as the accounts are comparable. It is easier to control multinationals as their financial statements are comparable, and it is easier for them to attract investment. It will be easier to collect tax as all financial statements will be clear and comparable, requiring adequate disclosures. With such great benefits to be had from convergence, what are the barriers to implementing it? 1. Corporate reports are used for many different purposes, and should these standards be developed to help tax assessment or investor decision making? 2. Different legal systems. Each country has a separate legal system and structure that company law stems from. Standard harmonisation may require some local laws to be harmonised. 3. Different systems place importance on different areas of the financial statements. In Europe, employees are given importance in the financial statements, and in the US, investors are given a higher profile. 4. Nationalism. The idea that local standards are better than foreign ones. Nationalism is in politics and business, and it is not surprising it is a barrier to the convergence of financial reporting standards. 5. Lack of local leadership in accounting bodies to drive harmonisation. 6. Circumstances. When a country is facing huge issues like war, sanctions, etc., they won't be focusing on how to harmonise their financial standards with international ones. Although we are far from internationally harmonised reporting standards, it is something that will happen over the next decade. These moves towards harmonisation will affect your day-to-day work, so it is important you understand the principles behind it, which I have outlined to you here. Thank you.